we're going to do the module of private equity. Let us look at what we're going to cover in this module. Number one, let's try and understand the overview of private equity. Then let us go about understanding that when one decides to make private equity, how are deals structured, or what is the deal structuring in a private equity deal. Thirdly, let us understand what is the difference between a company getting private equity or raising money through an IPO. Then, let us try and understand what the global private equity scenario is about. Then let us try and understand what you would be most interested in, which is the role of a private equity analyst. Fifthly, let us try and understand the peculiarities of private equity. And then let us obviously understand the yin and the yang, or the pros and the cons, and the issues with private equity. Let's move on and deep dive into what private equity is about. Now, what is private equity? Any company which is not listed or out there in the public domain is a private company. When you buy equity of a private company or become a partial owner of a private company is when you're investing or are a private equity investor. The two important facets of what makes up private equity is number one, that because it's not traded, it is not liquid, or let's say it's less liquid. The reason that makes it less liquid is the reason why you need to have a pretty long-term perspective when you invest in a private equity deal. So the two important facets of making a private equity investment is number one, that you may not have a liquid asset with you, and secondly is that you pretty much need to have a very, very long-term horizon when you invest in private equity. Let's further deep dive into what are the features of a private equity deal. Number one is that it is not a company that is listed on the stock exchange. By listed on the stock exchange, I mean that it is not listed on the Bombay Stock Exchange or the National Stock Exchange or any of the other regional stock exchanges, which means that on every single day, you do not have a quote on the equity of the company. It's a private company, which means that a lot of importance needs to be given on how to find that company that requires this investment. That's the first feature of a private equity investment. Secondly, the reason behind it not being listed on the market is what drives it to be a medium or a long-term investment for anyone. As a horizon, one cannot enter and exit it on a daily basis. One cannot trade in private equity. One can trade on a listed company. One can actually buy today and sell today on a listed company, or buy today and sell tomorrow on a listed company. But one can't do the same with a private equity deal. And the liquidity is so less that one better have a medium to long-term horizon, which in a sense comprises of at least 3 to 5 years. Most private equity funds have a life of 6 years, which in a sense gives you an idea of how far or how long one needs to be invested in a company when one does private equity. The third important thing is the multiple avatars that private equity has heralded from the time it started out. The kind of private equity that one can do is, there is venture capital, then there is angel investing, there is growth private equity, then of course you have what is called as a leveraged buyout model, and then you have mature stage investing. When I talk about venture capital or angel investing, it's about companies which have not reached a mature stage and who are showing phenomenal rates of growth. It's basically investing in an idea which is new or disruptive in some sense. Growth private equity is about investing in a company which has already reached they've got their processes and their business models figured out, and it isn't too, it's not too difficult. And it's about basically investing in a company which is on its growth path. Mature investing is about investing in companies which have gone beyond the growth path and are growing at a stable rate of growth. Leveraged buyout is a kind of structuring which is used to buy mature companies. Now let's look at the multiple sources for private equity. There are various sources of funds available for making private equity investments. The kinds of companies that are out there which are these sources of capital are basically your hedge funds, your pension funds, your endowment funds. Now, what exactly is a pension fund? A pension fund is basically, it's a fund which has got all the money from the government to manage the pension liabilities of a population that is going to age. But because the liability that's going to come up is going to be far greater as compared to the amount of money that is collected, the corpus of the pension fund needs to continuously grow. To enable that growth, the pension funds invest in asset classes which give them a certain rate of return. Pension funds are a deep source of funds for private equity. The other sources of funds that are available are endowments. Endowments are basically, they could be university endowments. All of us go and study at or want to study at the who's who colleges that are out there. So there's a Harvard or a Stanford or an MIT that's out there. We pay a certain fee to the college to be able to do the education. A part of that fees is used for research purposes. A part of that fees is used to build the infrastructure of the college, and another part of the fee is basically used in a corpus. That corpus is deployed into multiple asset classes to generate a return. That return enables the corpus to continue to grow, which in a sense makes endowment funds an important piece for private equity deals. The investors in private equity funds are called as the limited partners, and the PE funds are being managed by what are called as the general partners. We will obviously deep dive into each of these elements as we go through the course ahead. So let's move on. Let's look at the features of private equity. Let's again try and build the conclusion of what we've learned in the previous slides. Private equity is about being a part owner of a business, of a company which is not listed on the exchange. It is investing in a company which is privately held, which means that there is a single majority or maybe a family which owns a majority shareholding of the company. But to be able to buy into the company, one needs to convince the majority shareholders, which in a sense would mean that one needs to convince either the family or one needs to convince that single largest shareholder. It is a deal which one needs to source and look for, and it's not easily available. Once invested, one needs to have a medium to long-term outlook because the liquidity is low in such an investment. Now let's look at the multiple avatars that private equity has developed into. When somebody comes up with an idea which is totally new, it could be a new product, it could be a new process of developing the product. Because it's so disruptive, nobody really wants to put money in it, which is why it makes it a very risky investment. That is called, because nobody knows the outcome of it, nobody knows whether it's going to survive or not survive. But if it does survive, the rate of return could be far, far superior. That kind of an investment is called as an angel investing. Secondly, we have something which is called as venture capital. Venture capital is when, for example, the product is ready. there is some proof of concept which the product has been able to achieve, which shows a revenue model or cost model that is out there. When the company has reached such a stage, the company will approach venture capitalists for the right kind of investment. Thus, venture capital comes in when the company has achieved a right revenue model or the right cost model and has a proof of concept of the business or the idea that they are going to be running. Let's say the company has worked for about 3 to 5 years and is still growing gangbusters based on the new process or the idea that they've developed, is when growth capital comes into picture. Growth capital, in a sense, is when the company has streamlined its processes, has streamlined its business model, has its revenue model and cost models in place. It is when the company comes to growth capital private equity investors. After that, let's say the company has run for 10-15 years and it's at a mature stage of growth, wherein the growth rates for the company have reached stable rates of about 10 to 15%. It is when somebody may realize that you either need to go and acquire a new business, you need to go and acquire a business in the same industry, but basically to leapfrog the growth in some way, which means to entail higher risk. At that point in time, people use a structure which is called as a buyout structure, which we will of course deep dive further into as we go ahead. But buyouts are generally on companies with extremely stable cash flows and in mature industries and are mature companies. Now let's look at the multiple sources of PE, where PE funds are raised from, which we've again spoken about. We spoke about the pension funds and the endowment funds, but let us also talk about insurance companies. Now, what are insurance companies? Insurance companies are, in a sense, companies which are set up to provide you insurance in case of loss of life, in case of accident, in case of health. All those companies basically collect a premium from their various, from the various masses that are out there. They, in a sense, create what is called as a float. And that float is invested in two different asset classes to generate a certain amount of return, so that when the liability does come up, you are able to make the correct decision and you're able to meet the liability. Thus, investment becomes a very, very important part of insurance companies. Insurance companies are a very good source of private equity investment. Which other sources are existing out there? There are a lot of large corporates out there who've reached mature and stable rates of growth. They're generating cash flows and they don't know what to do with the cash flows anymore, which is why their treasury desks become very, very critical. Treasury desks, in turn, are an important source of making investments in companies and doing private equity. The other bracket that is available out there for private equity funding are the high net worth individuals. High net worth individuals are essentially people who run their businesses, who generate money through salary or dividend, and who've created enough wealth in their families to set up maybe family offices. Those family offices, in turn, are very, very important sources of private equity funding. Let us look at how private equity funds, or the ecosystem of a private equity structure that's out there. In the center, you have a private equity fund. The private equity fund makes investments into companies which are privately owned. The private equity fund gets its money from what is called as a limited partner. Thus, pension funds, endowment funds, etc., they basically invest into the private equity fund, which in turn invest into the different investments available to the private equity fund. The people who manage the private equity fund, who take the calls of what investment or how much of an investment need to be made in which company, is in a sense what is called as the general partner. The general partner is the partner who manages the private equity fund, and the limited partners are the source of capital for the private equity fund. That, in a sense, is the structure of how a private equity fund looks like. Now let's move on to the different categories and players that are out there in the world of private equity. We've gone through the entire gamut again, but let's summarize it once more. Angel investing. Angel investing is when there is a new disruptive product or process that's out there, which may be a boom or a complete bust. It's a binary figure. It's either a 1 or 0. And it's a very high risk investment, but if it does work, it's a very high return investment as well. This is what we call as an early seed stage or startup. These are the terms that are used for angel investments. Then we have what is called as a professional venture capital fund. As explained earlier, venture capital is when the product or process has a proof of concept. There is a business model in place and a revenue model in place, and one just needs the right amount of funding available to keep the company to continue on its path of growth. This could be to fund working capital, to fund customer acquisition. This, in other parlance, is an early stage investment, an expansion investment, or you can even call it a later stage to angel investing. Most angel investors do try and take a stake even in the venture capital rounds. The third after that is what we call as private equity or growth equity. This is when the company has moved, say, 5-6 years beyond venture capital and has reached a stable path of growth. The processes are more set. The company knows exactly how much working capital is needed. The company knows what kind of profit margins are available. The company knows what kind of clients are available. The company has its supplier profile set. Basically, this is a much later stage investment. At this time, what is needed is growth private equity. After that, we have what obviously is a mature stage investing, and which is also the buyout model, which I said when you have reached stable rates of growth. That comes under private equity itself. And then of course you have what are called as hedge funds. Hedge funds are basically funds which are named just so, they're an alternative investment asset class, and they basically invest in all stages of growth of the company. So it can be angel investing, it can be venture capital, or it can be growth private equity. Now let's look at the exact flow of how private equity works. You have, number one, the investors, or what we call as the source or the pool of capital that needs to be invested. Who are the sources of that pool of capital? Let's take a look again. We have pension funds, which we've discussed earlier. We have endowments like the university endowments, which we've discussed earlier. Then we have something which are called as bank holding companies, which is again treasury desks in some sense of corporates. Then we have high net worth individuals, which in a sense have made money through salary or dividend, and which have, these huge sources of capital, probably have set up family offices and want to deploy that money to derive a certain rate of return on that pool of capital. Then we have insurance companies, which we've spoken of earlier. Then we have, of course, the investment banks. The investment banks are people out there who basically help companies in raising capital either through equity or debt. If a company wants to go and acquire another company or merge with another company, they hire an investment bank to be able to find for them that company and value that company correctly. Based on that deal that goes through, the investment bank generates a commission. And those commissions, based on billion-dollar deals, is a pretty large amount. Thus, investment banks become huge sources of capital. And then, of course, you have corporates themselves, which we've already spoken about. Corporates, in their life cycle of growth of the company, generate huge amounts of cash flows, and those cash flows need to be invested correctly to generate right amounts of returns. So the treasury desks of companies themselves become sources of capital. And then of course you have other varied investors that are out there. Now, all this source of capital basically goes on. It can either go to what we call as a fund of fund. A fund of fund is in a sense a structure which uses these source of capital and invests in different funds. So for example, a fund of fund could invest in a listed fund, it could invest in a private equity fund, it could invest in a growth fund, for example, a venture capital fund, an angel fund, it could invest in commodities, in real estate, in different asset classes. Or, for example, this pool of capital can go and invest itself directly in a private equity fund. Now, the private equity fund in turn goes and invests in the kind of asset classes that it is monitored for. So, for example, an angel private equity fund would go and invest in companies which are at the seed stage. A venture capital private equity fund would go and invest in a company which is at a post proof of concept stage. A growth private equity fund would go and invest in a company which is on the path of growth. A leveraged buyout private equity fund would go and invest in a company which is more mature, in a more mature phase of growth. Then, of course, you would have companies which would be across a hedge fund. If, for example, you're a hedge fund, you would go and invest across companies across these different stages of growth. This, in a sense, captures for you how the private equity market looks like. You have the pool of capital, you have the people who help in deploying the pool of capital, and then you have where that pool of capital is deployed. Now let's look at what is the fuel of private equity. The one important tool is private equity. People who run private equity investments, they use debt as a fuel to help in doing the deal. That is, in a sense, the fuel of a leveraged buyout operation. We will discuss this going ahead. Then, of course, you have the investors. The investors need to be extremely patient and disciplined. They need to be patient because, like we said, it's not a liquid asset, and one needs to have a medium to long-term horizon, which is a horizon of 3 to 5 years. And they need to be extremely disciplined because they need to know what they're investing in, and only when they're comfortable in it do they have to make that investment. Thirdly are the managers. In a private equity deal, it's important to be able to, for example, if you're in an angel stage investing, one needs to have enough sectoral knowledge to be able to help the company with all the managers of the company with different avenues of growth, with giving them the right connections. That is true even in the case of venture capital. Or for that matter, let's say somebody invests in growth private equity, then finding the right network for the company to sell its products, or finding the right network to be able to procure its raw material would help the company in achieving its path of growth. Those are the managers. Thus, management of a particular private equity deal, helping in the operations, becomes very important. And then, of course, what's really important and which is not under anyone's control is the macro environment. So, for example, if you were in the coal sector right now, you would not be in a very happy space because entire commodities are crashing due to China. Thus, the macroeconomic environment becomes very important to the outcome of the private equity investment that you've made.